Let's get some more color from someone who's been in the room, of course, on Fed rate decision days, and that is former St. Louis Fed President Jim Bullard, now Purdue University's business school dean. Jim, good to see you. Happy Fed Day.
Happy Fed Day. Very exciting in the world of central banking.
Earlier in the year, you did say that 3 cuts, I think, was your base case. Has that been changed in recent weeks?
No, I think they should go 25 today and 25 at signal 25 at subsequent meetings. I think the case for 50 is overblown here. You've got a pretty robust economy. You were just citing Atlanta Fed GDP now 3%. For the third quarter, we got an upgrade from the second quarter to 3%. So it's pretty fast growth through the middle of the year here. Unemployment insurance claims, sort of ridiculously low. Lots of things looking pretty good about the economy. So I just don't think it's the kind of situation where you have to go 50. So I think what they can do here is go 25 and signal that, hey, we're going to keep 50 in our pocket. And if things deteriorate, we're willing to go faster. But we don't have to right now because the case isn't really there right now.
All right. I want to read you one of the notes out of Wells today. They write the Fed needs to provide more certain communication. If not, they risk needing to add excess accommodation later in the cycle as uncertainty weighs on activity. Do you think it needs to be more explicit than usual?
I think the chair did a good job at Jackson Hole saying that, they were ready to get going. And I think he meant, at least my interpretation was he meant that you'd start a string of rate cuts, but they would be orderly and methodical about it because the real economy is actually doing fairly well. And inflation isn't all the way down to 2% yet. It has, yes, it's come way down and it's been very successful policy, but you're not all the way to 2%. So it seems like, and I would say another thing to everyone that's listening here, you got the 2-year already down a long ways. So in a big sense, market pricing is already done most of the easing. So really, it's the signaling that the committee still wants to see inflation go all the way down to 2%, and they're going to gradually ease here, but only gradually because they want to get that last bit of inflation out of the system.
Everything you say makes sense. I agree with you. The counter argument, though, that they're using for 50, if you're in the 50 camp, is the 2-year yield is at 3.6. So the Fed is offsides. The Fed is too tight. So why not just make the adjustment now in a bigger way because it's going there anyway, given the inflation dynamics?
Yeah, in the first half of the year, I actually gave a talk at the University of Miami and actually made this argument that if you use Taylor rule type calculations, the policy rate was too high. They should start sooner, and then they'd be able to sort of glide into the 2% inflation target. They didn't do that. Just didn't have the data in the right position, I think, to make a move earlier. But now that you're here at September, I think going 50 would be very hard to defend. You've also got the SEP here. The SEP probably will indicate 3 rate cuts in a row of 25 basis points. So now how are you going to say, well, we went 50 today, and so we're going to skip one of the other meetings or something? I don't quite see how it's going to add up with the SEP. Sometimes the SEP does not go with the decision on the day, and then the chairman has to dance around that. But it seems to me like people will probably coalesce around 3 25 basis point cuts and keep in their pocket the option to go with bigger cuts later if there really is some deterioration in the economy. I mean, you're talking about an unemployment rate at 4.2, which actually ticked down in the last report. Is certainly not a situation that seems to call for panic.